Did you know that 60% of adults in America wish they invested more yet they don't? Quite a paradox, isn't it? It's an interesting conundrum, this desire to invest more paired with a lack of action. What's holding them back? Well, there's a myriad of reasons. The fear of losing money is a big one. It's a risk, no doubt about it. But remember, every great opportunity involves some degree of risk. Another common deterrent is a lack of knowledge. Investing can seem like a complex labyrinth of numbers and terms, daunting to the uninitiated. Then there's the belief that one needs a fortune to start investing. It's a misconception that's been stopping potential investors in their tracks for decades. But the truth is, investing isn't as complicated or as scary as it seems, and today we will show you how. So buckle up and get ready to demystify the world of investing. To begin with, we need to understand what investing actually is. Investing, in its purest form, is about growing your money. It's like planting a seed. You put that seed, your hard-earned money, into the ground. And with the right care, it grows into a tree, providing you with more seeds. Investing is putting your money to work. Instead of letting it sit idle in a bank account, you're giving it a job, and that job is to earn you more money. It's about taking calculated risks, with the potential for higher returns. But remember, with the possibility of greater rewards, also comes the chance of greater losses. Now you may ask, why invest? Well, the answer is simple. It's one of the most effective ways to achieve financial independence and grow your wealth. Investing can also help you beat inflation, the gradual rise in prices that can erode the value of money over time. By investing, you're not just maintaining your money's value, but you're also aiming to increase it. However, it's crucial to understand that investing is not a surefire way to get rich quick. It requires patience, diligence, and a well-thought-out strategy. It's about making informed decisions, not taking wild gambles. One key aspect of a successful investment strategy is diversification. Think of it like an all-you-can-eat buffet. You wouldn't just fill your plate with one type of food, right? Similarly, in investing, you wouldn't want to put all your eggs in one basket. By spreading your investments across a variety of assets, you reduce the risk of losing all your money if one investment doesn't perform well. In essence, investing is a balance of risk and reward. It's about learning to navigate the financial markets, understanding your own risk tolerance, and making decisions that align with your financial goals and values. So, now that we know what investing is, let's delve into the different types of investments. There are several types of investments out there, each with its own potential returns and risks. Let's start with stocks. When you buy stocks, you're buying a piece of a company, becoming a part owner. The potential returns can be high, as the company's success directly influences your investment. However, with high returns comes high risk. If the company doesn't perform well, your investment can decrease in value. Moving on, we have bonds. Bonds are like IOUs. When you buy a bond, you're essentially lending money to a company or government. In return, they promise to pay you back with interest after a certain period. Bonds are generally seen as safer than stocks, but they also typically offer lower returns. Next up is real estate. Investing in real estate involves purchasing properties, either to rent out or sell at a profit. The returns can be quite substantial, especially in booming housing markets. However, the risks are also significant. Property values can decrease, and managing properties can be time-consuming and costly. Then we have mutual funds. This is where you pool your money with other investors, and a professional manager uses this pool to invest in a diversified mix of stocks, bonds, or other assets. The potential returns depend on the performance of the assets in the fund. The risk is generally lower than investing in individual stocks or bonds, as the investment is spread across a variety of assets. And let's not forget about ETFs, or exchange-traded funds. These are similar to mutual funds but can be bought and sold throughout the trading day like stocks. ETFs can provide diversification and are generally more affordable than mutual funds. Finally, we have options and futures, more complex types of investments that allow you to speculate on the future price of assets. These can offer high potential returns but come with a high level of risk and are not suitable for beginner investors. As you can see, each type of investment has its own pros and cons, therefore, it's important to diversify your portfolio. It's natural to have questions and concerns when it comes to investing, especially if you're a beginner. Let's dive right into some of the most common queries that pop up. One question often asked is, how much money do I need to start investing? The answer is simpler than you might think. You don't need a mountain of cash to begin. In fact, many online platforms allow you to start investing with as little as $25. Another frequent concern is investing risky? The truth is, all investments carry some degree of risk. However, you can manage this risk by diversifying your portfolio. That means spreading your investments across a variety of assets, so if one doesn't perform well, others might make up for it. But what if I don't understand the stock market, is another common concern. Well, you're not alone. The market can be complex, but there are plenty of resources available to help you understand it better. Start with basics, learn about different types of investments, and gradually you'll find it less intimidating. A question that often pops up is, how do I choose what to invest in? This depends on your financial goals, risk tolerance, and investment timeline. It's generally recommended to invest in what you understand. So if you're a tech enthusiast, start by looking at tech companies. Lastly, is it too late to start investing? Absolutely not. It's never too late to start investing. The key is to start as soon as you can, no matter your age. Remember, the goal of investing isn't just about making money quickly, it's about growing your wealth over time. Investing might seem like a daunting endeavor, but don't let that deter you. Do your research, ask questions, and most importantly, don't be afraid to make mistakes. Mistakes are part of the learning process. Remember, every investor started as a beginner. And with the right knowledge and guidance, you can become a successful investor too. Now let's talk about fast lane investing. This is where things get exciting. Imagine you're on the highway of finance and you spot the fast lane, a place where speed and adrenaline are the rules of the road. That's what fast lane investing is all about. It's for those who are ready to rev up their investment engines, taking on high-risk, high-reward assets with the potential for significant returns. Let's break it down. Fast lane investing involves putting money into ventures like startups, volatile stocks, and cryptocurrency. These types of investments are known for their potential to skyrocket in value, but they're also notorious for their unpredictability. One minute you're soaring, the next you could be plummeting. It's a roller coaster ride of financial ups and downs. Now let's talk benefits. Fast lane investing can lead to substantial profits in a short amount of time. You're essentially in the driver's seat of a high-speed vehicle, and if you navigate well, you could reach your financial destination faster than you ever imagined. But remember, with great rewards come great risks. The fast lane is not for the faint of heart. It's for those who can stomach the volatility, the uncertainty, and the potential for loss. Because yes, while you can make a fortune in the fast lane, you can also lose big. So how do you decide if the fast lane is for you? Well, it's all about risk tolerance. Are you comfortable with the possibility of losing your investment? Can you handle the stress of market fluctuations? If the answer is yes, then you might be ready to strap in and take the fast lane. But if you're more comfortable in the slow and steady lane, there's absolutely nothing wrong with that. Investing is not a one-size-fits-all journey. It's about finding the right balance for you, a balance between risk and reward, between thrill and stability. Fast lane investing can be a game changer, but it's not for everyone. It's important to assess your risk tolerance before diving in. Fast or slow, the most important thing is that you're on the road, driving towards your financial goals. Investing is more than just a way to make money. It's a way to secure your financial future. Now that's a bold statement, isn't it? But let's take a moment to unpack it. Investing isn't just about growing your wealth, it's about setting yourself up for success down the line. It's about strategizing, making informed choices, and most importantly, it's about having a vision for the future. Think of it this way: every dollar you invest today is a building block for your future. Whether your dream is to buy a house, start a business, or even retire comfortably, investing can help you get there. It's like planting a seed today and reaping the benefits in the future. And remember, investing isn't exclusive to the wealthy or the financially savvy. With a bit of knowledge, a dash of patience, and a sprinkle of courage, anyone can join the ranks of investors. So, there you have it. Investing isn't as daunting as it seems, and with the right knowledge and mindset, anyone can become an investor.